The separation structure means business money lives in your business account and personal expenses live in your personal account. And those two accounts now need a documented flow between them. That flow has different shapes depending on your entity type. Owner draw for sole prop and single member LLC, reasonable salary plus owner distribution for S-Corp, and the bookkeeping entry that accompanies the transfer is what makes the flow legible to your CPA at year end and to an auditor if one ever shows up. The transfer itself is mechanical. The entry is where the precision lives. Two accounts, one flow between them, and the entry is what matters. The transfer is just clicking move money in your banking app. The bookkeeping entry recorded against that transfer is what tells your CPA next year whether you took compensation, returned capital, distributed profits, or paid yourself reasonable wages through payroll. Same physical motion at the bank, completely different categorization on the books, and the categorization is what your tax return is built from. The flow without the entry is the pattern that creates pattern 4 mixing, covered in Unit 6.8. Sole prop and single member LLC first, because that's the simplest compensation structure in small business and where most founding coaches start. You transfer money from business checking to personal checking. No payroll, no W-2, no withholding, no payroll tax filings. Your taxable income at year end is the business's net profit, total revenue minus deductible expenses, regardless of how much or how little you actually drew across the year. You could draw zero, or you could draw every dollar of profit, and your tax bill is the same. The draw is access to money the business already earned and that you've already been taxed on through the Schedule C. The bookkeeping entry for an owner draw is exactly the same shape every time you do one, and getting it right matters more than the size of any individual draw. Debit owner's draw, which is an equity account. Credit business checking, which is an asset account. The entry reduces your equity in the business and reduces the cash on hand. And that's all it does. It doesn't hit your profit and loss statement. It doesn't change your taxable income. It doesn't create a deductible expense, and it doesn't create taxable compensation, because for a disregarded entity, the draw isn't compensation. It's access to money you already own. If you've elected S-Corp treatment, the compensation structure changes in a structural way, and the change is what creates the S-Corp tax benefit. The IRS requires you to pay yourself a reasonable salary through payroll, W-2 wages, subject to FICA on both the employee and the employer side, deductible to the S-Corp as a business expense. The reasonable salary methodology is Module 11.2, and tax court precedent on what constitutes reasonable is consistent enough that you can defend a number built methodically. Salary first, run through payroll on whatever schedule your payroll provider supports, usually bi-weekly or monthly. After the reasonable salary and the business expenses, what's left of the profit can be distributed to you as an owner distribution, and the entry pattern for distributions is the same shape as the draw entry, but uses a different equity account. Debit owner's distribution, credit business checking. The reason the entry matters separately from the draw is that distributions to S-Corp shareholders are not subject to self-employment tax and not subject to FICA. That's the entire S-Corp tax benefit in one sentence. The distribution portion of your compensation escapes the 15.3% SE tax that a sole prop or LLC owner pays on every dollar of profit. Once money leaves the business account and the bookkeeping entry is recorded, the personal side is irrelevant to your business books. You do not track what you spend the money on inside the personal account. You do not categorize personal transactions against any business chart of accounts. Whether you spend the draw on rent, on groceries, on a vacation, or on a Roth IRA contribution is between you and your personal finances. The business side bookkeeping is complete the moment the entry is recorded. This is the boundary that the separation structure was built to create. Business books stop where personal money begins. Clear is a composite that shows the bookkeeping cost of doing draws ad hoc instead of on a schedule. Single member LLC pulled money out of business checking whenever she needed it. $500 on a Tuesday because rent was due, $2,400 on a Thursday because a credit card was due, $800 2 weeks later because of a school payment, no pattern. Her bookkeeper spent 2 hours per monthly close just on draw entries, because every transfer had to be researched, classified, and recorded individually. She switched to a monthly draw on the first of every month. Same total compensation, predictable single entry per month. Monthly close on draw entries dropped to 30 minutes. Decide on your draw amount and schedule this week, and execute one transfer to establish the pattern. If you're sole prop or LLC, that single transfer with the bookkeeping entry recorded is the working version of the system. You scale it forward from there. If you're an S-Corp, confirm that payroll is running correctly before this video is fully useful. Module 12.8 covers the S-Corp payroll setup, and the distribution flow only works on top of a payroll system that's already producing accurate W-2 wages. Mark the recurring draw or distribution in your calendar. Anchor it to a date that's easy to remember. The first of the month is common. 6 units done. The structure is built for any coach with US-only clients in US dollars. The next video is for coaches with international clients. Anyone receiving payments in euros, pounds, Swiss francs, Canadian dollars, or any other non-US currency. If all your clients pay in US dollars, you can skip directly to Unit 6.8, which covers the cleanup protocol for coaches who have been mixing accounts.